Now, today I want to discuss about the health sector, its investment outlook for June 2025. Okay, so before I jump into that, I think it's also good to give you a sector overview of this healthcare sector. Now, the healthcare sector remains one of the most compelling long-term investment opportunities. Historically, only three sectors have consistently outperformed the S&P 500 over extended periods. It is technology, consumer discretionary, and healthcare. So trading stocks is about working, on possibilities, right? So if you read this and you look at it and it says historically only three sectors have consistently outperformed S&P 500. So that means only these three sectors, if you focus on it and your strategy is about buying stocks, then if you look at these three stocks, the technology, the consumer discretionary, and the healthcare, you have a higher chance of winning, right? Correct? So as opposed to those that want to short stocks, then you look into areas that says they don't perform that well. What type of stocks, for example? Look into that, and that's how you increase your winning probability, right? But today I just want to discuss about the healthcare sector. Now, the healthcare sector benefits from circular growth drivers such as global population aging and the rising prevalence of chronic diseases. Okay, as you know, there are more and more people who are getting older nowadays, and that is a real fact. And on top of that, we have prevalence chronic diseases now, like for example, like cancer. It's something very, very common nowadays. We hear that, people having cancer. Now, this is like a tailwind that supports the healthcare sector. Now, importantly, healthcare is also defensive in nature. Demand for essential medical products and services is largely inelastic. Even during economic downturns, individuals continue to require medication, hospital visits, and other health-related services. This combination of resilience and long-term growth makes the sector particularly attractive amid macroeconomic uncertainty, right? So now, however, despite these fundamentals, the healthcare sector has underperformed over the last 12 months, registering a 29% decline, the worst performance among S&P 500 sectors. Now, this raised two key questions. Why has this occurred? And does it represent a value opportunity? So, understanding the healthcare sector's defensive profile. Yes, the healthcare sector is widely categorized as defensive due to the following characteristics. Number one, inelastic demand, regardless of economic conditions. Healthcare needs persist. Global demographic trend, aging populations, and the prevalence of chronic diseases further reinforce this. Stable cash flows. Pharmaceutical, medical devices, and insurance companies often generate recurring revenue from essential products and services. Low earnings volatility compared to cyclical sectors like industrials or technology. Healthcare companies show less earnings sensitivity to macroeconomic swings. So from a macro context, amid tariffs, possible persistent inflationary risks, and slower global growth projections, investors are revisiting the healthcare sector as a stable refuge with strong long-term fundamentals, right? So because of this, I want to focus on a few companies, basically two, right? Now, the first is UnitedHealth Group. So there are recent challenges to UnitedHealth. First of all is cost overruns. Post-pandemic, UnitedHealth underestimated healthcare utilization rates, particularly among older demographics. This led to, number one, higher medical costs ratios. Number two, profit margin compression. So Next is leadership transition. The resignation of the CEO added to investors' uncertainty. And lastly, withdrawn guidance. Suspension of full-year forecasts signals near-term unpredictability. But apart from the challenges, you obviously have opportunities and strength. Growing customer base, this is definitely something that UNH has. Structural growth in members remain intact. Premium adjustments, upcoming pricing revisions aim to restore margin stability. And they also have improved capital efficiency. ROIC has risen from 7% in 2016 to 11%, reflecting more efficient capital allocation. All right. So a deep dive into its financials, you will see this. Number one, the revenue, net income, and EBITDA. Basically, those that are new, it means earnings before interest, tax, depreciation, and amortization. This here is the top left one. Now, revenues have grown consistently year over year, reaching nearly 400 billion plus in 2024. Net income and EBITDA have grown, but not proportionately to revenue, indicating margin compression. So what's the interpretation of this? Growth is strong, but profitability hasn't scaled as well due to rising costs. While rising costs are currently restricting profitability scaling relative to growth, strategic measures and operational efficiencies could improve UnitedHealth's profitability in the future. Continuous focus on expanding high margin sectors and cost control initiative will be vital. Next is the cash and debt versus debt, right? Now, debt has steadily increased, reaching 76.9 billion, up from 16 billion in 2013. Cash reserves have grown too, but not at the same pace, now at 29 billion. So there's a caution here. Overall, while there's an increase in debt, UnitedHealth's debt levels appear to be strategically utilized for expansion and doesn't currently present alarming financial strains, especially given their substantial revenues and still manageable interest coverage ratio. However, continued monitoring of debt levels relative to earning expansion and industry conditions would be prudent to ensure sustainability. As for the cash flow quality, operating cash flow and free cash flow are strong and relatively stable over the last 5 years. Net income is constantly covered by free cash flow. Cash for dividends is stable and well covered. Stock-based compensation is small, suggesting low dilution risk. For strength, UnitedHealth generates robust recurring cash flows, which is vital for weathering cost volatility and maintaining dividend stability. So next, the final one is ROIC versus weighted average cost of capital. Basically, the returns versus the cost, right? So ROIC is consistently above WACC with a spread. The spread means the difference of 3 to 5% over the years. ROIC is hovering around 10 to 11% plus, indicating strong capital efficiency. WACC is relatively stable, and the positive spread, which is ROIC minus WACC, confirms value creation. So the interpretation for this, UnitedHealth remains a capital efficient, shareholder friendly company despite recent execution missteps. For valuation, intrinsic value estimated at 570 per share. Forward PE ratio 13.46 is near historical lows for UnitedHealth. The outlook, UnitedHealth appears undervalued with strong fundamental and potential for rebound once near-term headwinds subside. Okay, so next company and the focus is Novo Nordisk, ticker symbol NVO. Now the key strength, explosive revenue growth driven by its blockbuster weight loss known as GLP-1 and diabetes treatment. NVO has outpaced competitors in growth over the past 2 to 3 years. For profit margins, operating margin is a stellar 48%, up from 37% in 2012, far superior to most healthcare peers. High ROIC is also its strength, although declining slightly. ROIC is still above 26%, indicating strong efficiency in generating shareholders' return. Now, risks to monitor. Number one, high expectation built in. The market assumes strong pipeline execution. Any regulatory setback or competition, example from Eli Lilly, could dampen future earnings. R&D dependency, like most biopharmas, its future hinges on clinical trial success and new drug approvals, making it more volatile than health insurance companies. A deep dive into its financials reveals this. Number one, revenue, net income, and EBITDA. Explosive revenue growth, as you can see from here, driven by its blockbuster weight loss and diabetes treatment. Novo Nordisk has outpaced competitors in growth over the past 2 to 3 years. You can see from here, there's a strong push. Now, profit margins, operating margin is a stellar 48%, up from 37% in 2012. It's far superior to most healthcare peers. High ROIC, although declining slightly, ROIC is still above 26%, indicating strong efficiency in generating shareholders' return. Now, for the cash versus debt, rising cash reserve, cash holdings have steadily increased, showing solid liquidity. Spike in debt. Now, that's a spike in debt. Let me show you here. This here, suddenly there's this huge move up. Now, what does it mean? Significant surge in debt in 2024, reaching over 14 billion, much higher than previous years. This is a notable red flag. However, on a deeper dive, the debt in 2024 rose significantly, mainly due to the acquisition of 3 Catalan manufacturing sites. This acquisition was primarily debt finance, which increased the company's borrowing. So if it's debt based on the premise that is used to increase for future earnings, then I would categorize that as good debt. Okay. So in addition to this, substantial capital expenditure to expand the supply chain for future growth is both injectable and oral products also, okay, contributed to the rise in debt. Now, the increased investments in capacity expansions were part of Novo Nordisk's strategy to support the scaling of their supply chain to meet rising demand for their products, including GLP-1 based treatments for diabetes and obesity. As for cash flows, operating and free cash flow, both operating and free cash flow have shown consistent and strong growth, outpacing net income, a sign of strong cash generating capabilities. Now, for dividend payout covered, cash flows for dividends is increasing but still manageable, not impairing core cash flows. Negligible stock-based compensation, minimal dilution risk from share-based payouts. So the verdict, very healthy cash flows, supports future dividend growth and capital expenditure investments. For the ROIC versus WACC, ROIC is more than WACC consistently. Even though ROIC is declining, it still far exceeds the cost of capital, which means the company is creating value. The ROIC minus WACC spread is positive, though narrower, still 20 to 30% spread, signaling strong capital efficiency. Now, ROIC decline could be due to heavy reinvestments in recent years, a temporary and acceptable trend for growth firms. So the verdict still highly efficient despite ROIC compression, positive economic value added. So for valuation, intrinsic value analysts discount cash flow method estimates the stock to be worth $150, but it currently trades around 80, suggesting it's undervalued. The forward PE around 18.21, higher than UnitedHealth, but justified due to superior growth and margins. Okay, so these are the 2 stocks that I'm looking at. And later, when it comes to the charting area, that I will show you exactly where could be a good area to look into it. Okay, so with that, that's the fundamental report for today.